The stock market is weak. Yes, I said it. $15 trillion printed since the financial crisis and record low interest rates for a decade, and we still can't get off the addiction. It's supposed to be a temporary measure. It's just for a little while, they said. But here we are literally 10 years after the initial injection, and China just put in a record amount of money into the system to prop it up. Does that sound healthy to you? You came here for the truth, so let me unveil that for you. Today we're going to look at the markets. We're going to talk about China and what they have just done. I want to show you some other economic indicators, a lot to cover today. So let's begin by taking a look at the markets. This right here shows us that the US markets ended up in the positive for another day. They shook off all the bad news. Who cares about that? Netflix went up because they're putting their prices up, and the whole market chased after that. Congratulations, Netflix, for doing so to your customers. The stock market loves it. This is the moving averages of the US markets, whether we're looking at the NASDAQ, S&P, Russell, and the Dow Jones. The only one that has now moved above its 50-day moving average is the NASDAQ. So we're looking at that one just barely creeping over. The other ones should make their way above these averages in the coming days. Shouldn't take long with all this money printing that's going on, all the easy monetary policies. It's a wonderful world. It's a wonderful life. China's central bank injects a record $51.6 billion in open market operations. This is a direct injection from the central bank themselves. They are not going around. They are not doing it in secret. China's central bank on Wednesday made its biggest daily net cash injection via reverse repo operations on record. More evidence that authorities are shifting to policy easing to counter a slowdown in the world's second largest economy. Their stock market right now is in a bear market, and it's been there for the longest period of time. It has been month after month after month, and while we do see some upward motion on certain instances, the trend has been down for a long time. This article out of Reuters gets into it. I have some more information to cover. The People's Bank of China said that the injection was to maintain, quote, reasonably ample liquidity in the banking system. Why can't it be there on its own? Why does the central bank have to print up money and then put it somewhere? If the economy is healthy, if there is growth, if the stock market is strong, you wouldn't need any of this. You wouldn't need easy monetary policies. But here we are, a decade out from the financial crisis, and the same garbage is happening today. It attributed the generous liquidity support to the current peak period for tax payments, adding that the banking system's overall liquidity is falling rapidly. That's directly from their own statement. This is not coming from me. This is not coming from Reuters itself. This is from their own statement. On a net basis, the PBOC injected $82 billion for the day, as 10 billion yuan reverse repos are set to mature on Wednesday. This is massive. It is a massive level injection on a single day. China's doing it right now, and it's obvious they are worried sick about what's happening to their markets, to their economy. The growth is slowing down. They have actually said that they are going to have growth between 6 and 6.5%. That is very low for China historically, and that is using their buffed numbers, not even the ones that are actually in fact the reality. These are the numbers that they want people to know, and so we can expect them to actually be much, much lower. They're going to have to print a lot more than $82 billion to get this to happen. I'll show you two charts. One is China's imports, the next is the exports, and both of these year over year we're looking at this declining, whether we're looking at it through the later half of 2018 or even the beginning of it. It's all bad right now for China, even though we've had supposedly great news coming out left and right, but it doesn't seem to do anything. Look at the exports, the same business happening right now. It's not just China that's the problem. We're seeing the slowdown in Europe. We're seeing the slowdown in the US. We're seeing it in Canada, that's for sure. We're seeing it in Australia. There are different points that we need to look at here, and China is just one example. David Rosenberg has a great Twitter account that you can check out on a regular basis. The New York Fed recently updated its recession risk model up to 21% in December. That's up from 15.8% November, and 14 in October. The odds have doubled in the past year and hasn't been this high since August of 2008. You could see it right here on this chart at the bottom. New York Fed probability of a recession 12 months ahead. Yes, it's only 21%, but this obviously shows us that they are willing to admit the recession risk is the highest it has been since the financial crisis. At least we have some level of admission that things are getting closer and closer to what's coming. I show you this every month for those who are new to the channel. Bank of America Merrill Lynch has a global fund manager survey, and it's interesting to get the data from these. I'll show you several charts from this right now. What we're looking at is the net percentage say that global profits will improve. That's the blue line. And the yellow line is the net percentage expecting a stronger economy. And this has fallen through the ground. At the same time, these individuals are saying there's no recession coming. So something is not right now. People don't believe that growth is going to be there. They don't believe that the future is bright. At the same time, they're not saying there's going to be a recession because that would be negative. That would be bad. Well, we got a problem right now going on and they can't choose a side, it seems. Very funny. This is the chart right here just showing us that only 14% of these investors expect a recession in 2019 because, of course, that would mean that they have to do something. Well, if we just keep it where we are and hope and pray and cross our fingers, cross our toes that everything's going to be fine at least until next year. Maybe 2020, that's when it's going to happen. Not now, not 2019. So let's just hold on to everything and let's just buy FANGs. Let's just buy the dip and we'll be fine for now. At least make up your mind. That's all I'm saying. This is the biggest tail risk. You can see that still the trade issues are obviously on the top of the list. However, for January 2019, the trade issues have reduced. So the percentage of them has declined where it peaked out in the middle of last year or so. That has waned, but it's still the number one possible tail risk for these fund managers. The trade issues even going beyond the quantitative easing issues, which in my opinion, is not accurate. We should be paying a lot more attention to what the central banks do. That's why I focused on China at the beginning, because I know that one central bank at the very least has to be printing to keep up for all of those who are tightening. And the most crowded trade right now in January 2019 is long US dollar. We also saw this back in December and we saw it back in 2017, but it was always long FANG stocks. And while that's still somewhat of the trade of the day, especially since the dip, we have seen long US dollar taking over because number one, in 2018, it performed very well. And also the fact that people are unsure of what 2019 is going to look like until the trade issues are resolved. So they're going to dollars and they're just sitting and waiting and they're crossing their fingers and hoping for the best. This is going to get very interesting right now in early 2019. So far, despite some tweets that we saw, the actual information that's provided from the global geopolitical issues we've seen, particularly with China and the US, has not been positive. The State Board of Health says that 900 healthcare workers have been in danger of losing their license over the past 2 years because they were in default of their student loans. There's more details in this article, but I just wanted to show you the severity of the situation that people are in today. We have something like $1.5 trillion in student debt, credit card debt, mortgage debt, personal line of credits, and so on. People are in desperation at this moment, and we're being told that the economy is booming because of this or that. Look, you can skew the jobs numbers any which way you want. But I want to look at the 10 cities. I want to look at the amount of people that are living in their vehicles. I want to see how many people are living on the streets, and that's going to tell me what's really going on, not some of these ridiculous and absolutely ridiculous statistics that they put in front of our faces, and people should be laughing, but instead they're suggesting everything is just fine. It couldn't be further from the truth. Last but not least, you can see this pawn shop owner says that he sees 10 to 20 federal employees every day during the shutdown. Now, you can look at it the way the mainstream media looks at it, but what this tells me is that people are living paycheck to paycheck, even government employees in this case here. And what are they going to do when the money runs out? Well, they go to the pawn shops, they start to sell things, they have to cut back on things, and that's fine in some ways, but this could be a very big problem as it gets more widespread. Imagine it wasn't just federal employees. Imagine we had an actual recession where widespread we're having people that are getting laid off. Suddenly they're taking temporary work. They're doing things that they don't want to be doing. Maybe they are injured. Maybe they are sick and they can't be working right now. And now they're struggling. The money's not coming in the way it used to. There's all sorts of different problems that could happen at any given time, whether it's because of the shutdown, whether it's because of a recession, whether it's because of some industry that has been disrupted, a sector is no longer profitable. There's any number of issues that could happen, but all I know is that people are living paycheck to paycheck. And while that was a problem, let's say 10 years ago, it's more of a problem today, and it's going to be more of a problem next year, and so on and so forth. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, these two books have everything that you need. You can check them out at the link in the description. It's going to give you the ability to flip through the pages of the book to see if you like them for yourself, and if you're more interested in the audiobook version, you can get that at themoneygps.com.